Hey guys, this is Sandy. I'm a licensed realtor here in the Central Florida area and also a licensed mortgage originator. Today I want to do a topic on what kind of expenses do you have beyond the mortgage, right? So you're looking to buy a home, you have a home, you want, if I was to buy this home, what kind of expenses should I expect beyond the mortgage? Let's get into it. So, when you buy a home, you're going to have the mortgage, that's preset. And there's some prepaids that the bank will allow you, that the bank will want to put in the mortgage payment, especially if it's a conventional or FHA, which you put in 20% or less down, normally like 3.5%, 5%, 10%. The bank is going to escrow your taxes and your insurance into the mortgage. So the tax and insurance most of the time will be a part of your monthly payment unless you decide to opt out of that. If you're a first-time homeowner or you're not seasoned in the home buying process, I would not advise that. Remember, I keep forgetting this. My team keep telling me to do this. Remember that you need to like and share. If you like the video that we're putting out, like and share, and then you could click on the bell to get notified when there's a new video. So let's get into this one. So it's very important, of course, if you're going to be buying a home, to know if you could afford a monthly payment or not. And most banks, especially if you're a first-time home buyer, most banks will want you to escrow your property taxes and your insurance. Now, it becomes a little bit tricky if you're buying new construction home. Because with a new construction home, the property taxes is going to be based upon the land itself. It's not going to be based upon the structure that just is built on it. It typically takes a year or two before you start to get the real taxes with the improvement on the land, which is the house that was built. And a lot of people find themselves in that kind of situation where they bought the home and a year and a half later, their bank sends them an escrow shortage letter saying, hey, your monthly payment is going to be increased because your escrow is short this amount of money. You could either pay it up front or we could divide it in the next 12 monthly payments. So what's an escrow account? So escrow account, when you get a mortgage, the bank is going to set up an escrow account. The escrow account is what they use to put for you to save towards paying your insurance and your property taxes. So at the closing table, they're going to let you pay for some of it up front based upon what time of the year you're closing. Let's pretend you're closing in August, and in that particular county, the taxes are paid in September. So if you're closing in August, it means you'd have to pay the full year tax for September to the following August, right? You'd have to pay that up front. But for the same example, let's say the taxes are due in September, but no, you're closing in February, right? You'd have to pay back what the previous owner paid. So let's pretend that the people you're buying the home from already paid the taxes for the year. They paid in September for the year. Now you're closing in February. They're going to have to prorate and you're going to have to pay them back what they paid. And then the bank is going to prorate the taxes to put that as a monthly payment. So if the taxes are, say, $4,000 a year, they're going to divide that by 12. And based upon what time of the year you're closing, you're going to be paying that monthly so that when the taxes are due again, the bank is just going to take it from your escrow account and pay it. So those monthly payments are kept in an escrow account by your lender or by the mortgage banker. Same thing with your property insurance. Most banks is going to escrow for property insurance. So at the closing table, you're going to pay for the entire year because it doesn't really matter if whatever the homeowner does, you can't use their property insurance. So you're going to buy your own insurance, you're going to pay for the year. So beginning the first monthly payment, when you start paying your mortgage payment, they're going to be dividing. So let's say it was $1,000 a year for your property insurance. They're going to divide that by 12. So that amount will be paid from the time you start paying your mortgage. That would be a part of that. And that's going to be held in the escrow account. So the escrow account is holding the monthly payment you're making on your property taxes and the monthly payment you're making on your property insurance so that when they're due, the bank will take the money from the escrow account and pay it. Now, in the case where the property insurance increased the following year or the property taxes increased the following year, the bank is going to send you a letter. Because at the end of every year, every bank is different, but somewhere between February and March, you're going to be getting an escrow letter from the bank saying, hey, your escrow balance is over or is short. If it's over, you get a check. They normally mail a check out to you. They don't hold it. If it's short, then that's where the problem comes in, because if it's short, then the bank is going to say it's short by this amount of money. You could pay that up front, or we could divide it in the next 12 monthly payments. So in the case, back to our new construction example, let's say when you bought the new construction home, they were only taxing the land. So let's say the land was $2,000 a year, right? So the escrow was based upon $2,000 a year. Now in the following year or the year after that, the tax assessor's office finally catches up with you or with your property. And now they're going to tax it based upon the improvement, which is the house that's built on it. So now your property tax is going to increase. So let's say from $2,000 it increased to $6,000. It's going to be a big increase. So now your escrow account for that year would be short $4,000. So what a lot of banks are now doing to offset that is to kind of estimate what they think your property taxes will be. So you start paying into those property taxes a year ahead of time, so they'll be able to pay it at the year that it actually kicks in, if that makes sense. So when you buy new construction, you need to find out what are the predicted taxes. For most areas, it's going to be 2 or 3% of the purchase price. So if you're buying the property for $300,000, 1% is $3,000, so 2% would be $6,000. So you're going to have to say, okay, it's going to be between $6,000 to $7,000 with my property taxes. The bank is only escrowing for the land taxes, so I'm going to have to put some money aside so I'm not blindsided when that happens. And this is very, very important, because one of the biggest things to increase your mortgage payment is when your property taxes or property insurance increases. Now, beyond that, what are some of the other expenses? Well, what about your appliance? Your appliances is going to come into play, because the appliance could break down or something could happen to your air conditioning system, as in the case that happened to me this weekend, actually. So you want to either do a home warranty insurance, right? So home warranty insurance is where you take out an insurance policy with, to protect your appliances. So if your air conditioner, stove, dishwasher, any of that stuff breaks down, you call them and they'll come out and either fix or replace the item. So that's one way to kind of not get shocked with when an expensive home appliance breakdown, like a hot water heater or air conditioning system, which is very expensive right now. If you're in Florida, or if you're in New York, your furnace or your boiler doesn't work. That's a big expense. So you may want to consider doing home warranty insurance if you're buying a home and you're concerned about that kind of thing. If it's new construction, there's a bunch of warranty on it, but if it's a resale, you may want to consider that as well. Another thing is the maintenance of the property, right? So beyond your mortgage, you got to maintain this property. So if you have a lawn, you got to think about, well, what's the monthly payment to cut the lawn? If you have a pool, what's the monthly payment to maintain the pool? Or am I going to do that myself? Am I going to get my little lawnmower and cut my own lawn? Or do I have time for that? Am I going to maintain the pool myself if you're in a state where pools are popular? So the maintenance is going to be important. And the funny thing is, you don't want to not pay attention to the maintenance of the property and wait until you have a lot of deferred maintenance, because then that's too much, right? So you want to think about, if there's gutters on the property, who's going to clean the gutters, or how often you're going to get the gutters clean. For your air conditioning system, you want to get that. You got to change a filter every month. But then every 6 months, you want to get a tune-up, right? Every 6 months, you want the AC company to come out and do a checkup on the system. You got to think about that. Once a year, you have to drain your hot water tank to help it to maintain better. You got to think about that. So you got to think about all the maintenance and think about who is going to be doing these maintenance. Am I going to be doing it myself? Am I going to just watch a little YouTube video and do my little work thing, do it myself? Or would I need to hire a professional? All this you got to factor in when buying a home. So for an example, you could say, okay, I am paying $2,000 a month now in rent, so I could pay that in mortgage. Cool. But then is there added expense coming with the mortgage? Because with your rent, you're not maintaining the property. With your home, you are maintaining the property. And I'm not trying to tell you not to do that. I'm just saying these are things you got to think about. And these are some of the expenses, apart from the utilities, that you need to think about. Utilities also come into play, because the utilities may be more than you expect, right? Because maybe you live in a 1,200 square feet apartment. I know you're buying a 2,000 square feet home. You're going to have more home. You're going to have more homes, so you're going to have a bigger utility bill to cool or to heat or whatever you're doing. So that's going to be important. Also, you're going to be buying furniture. And you're financing the furniture, you're going to buy the furniture. So all this got to come into play. So these are some of the things that you must think about if you're thinking of buying a home or thinking of what would go beyond the mortgage. And remember, property taxes and insurance is two of the things that will cause your monthly mortgage payment to increase. If you're in a fixed mortgage payment, that means you have a fixed interest rate. The only two things that could increase your monthly payment is going to be if your property taxes increase or if your property insurance increase. Other than that, it will remain the same. And over the last few years, all these things have been increasing because property values are increasing. So if property values are increasing, then you're going to have property taxes increasing and property insurance also will be increasing. I hope this helps. If you have any questions or want to discuss this more, feel free to reach out to us by texting us. The number should be somewhere up here. You could text or call, and we could set up a consultation with you through the phone or on a Zoom call and go over more with you. Thank you so much for watching, guys. I'll see you in the next video.